Roth IRA, traditional IRA, non-deductible IRA. These are all terms that are thrown about, but what do they mean? And how does it help you save more? I'm Kevin Gaines, American Financial Management Group. When you got your first job, for example, your parent or maybe a friend or somebody else may have, said to you, hey, you should open, now that you're earning some money, you should open an IRA. Or you talk to your accountant and they say, hey, if you want to shave a couple bucks off your taxes, open up a retirement account. But what are they really suggesting to you? So IRA is short for individual retirement account. This is the type of account that the federal government created almost 50 years ago to encourage people to save for their retirement outside of their employer. The key part of individual retirement account is individual. This is yours. It doesn't matter which company you're working for, if you leave your job, when you switch jobs or anything like that. This is an account outside of that. Nobody has any control over it other than you. So you don't have to, when you switch jobs, you don't have to worry about losing a benefit or anything like that. So how the IRA works is, or at least the basic, we'll start with the basic structure, the traditional deductible IRA. And with that, the IRS has said, if you put in up to a certain amount, in 2020, it's $6,000, a little bit more if you're over 50, but you can put in up to $6,000 and you'll be able to deduct that off your taxes. The money will grow tax deferred, so you don't have to pay tax on it each year like you do with a regular investment account or even a checking account at your bank. When it does come time to start taking your money out because you're done working and you want to retire, when you take that money out, you do have to pay income tax on it. But until then, there's no tax. So it can grow a little bit faster because you're not having to write a check to the IRS each year for the extra money it earned. It's a nice structure. It works, it can work well. Like I said, the limit is this year for 2020, it is $6,000. So it's not that you can put a whole lot of money into it on any one year, but over time it'll add up. There's also a restriction that says if you earn too much money, you won't be able to take the deduction. But you can still contribute, and that's a key part. You can still put money in. It's just whether you can take the deduction or not for it. Contrast that with, a regular savings account or a CD or stock trading account that you might have with, some local broker. Each year, the money you earn, whether it's from interest, dividends, or profits from buying and selling, you have to pay tax each year. But you don't have to do that with an IRA. And I want to stress this. Other than that, it's the same thing as the regular account. It's just when you pay the tax, that's the difference. Clients will ask me the question, should I invest money in stocks or should I invest in an IRA? And that's the wrong way to phrase it because it's not a choice that way. The better way to ask the question is, should I put the money into a taxable savings account or an IRA? And there's pros and cons to each. For example, if you put it in a taxable account, you can take the money out whenever you want. Put money in an IRA, you cannot take that money out whenever you want. Well, you can, but the IRS is going to charge you a penalty for that. Typically, it's a 10% penalty in addition to having to pay income tax on whatever you take out. So there's definitely a penalty for or discouragement to take money out before you reach your retirement age, which is typically 59 and a half, although as with all things in tax laws, there's always weird exceptions. So that's what a traditional IRA is. Now, fast forward about 25 years after the original IRA was created, and then the government came out with the Roth IRA. And with a Roth IRA, they said, hey, if you could put the money in today and you pay the tax on it, so you don't get the deduction, We'll let that money continue to grow tax deferred, but now when you take it out, you don't have to pay any tax at all. Not on the money you put in and not on the money you earned. So for a lot of people said, hey, that's a really good deal. I want to do that. Now, there's trade-offs for, there's going to be times you still want to use the traditional IRA, and there's going to be other times you want to use a Roth IRA. And this video really isn't getting into the strategies and which times work better. And frankly, in several levels, it's a personal decision based off of your own particular goals and set of circumstances that will dictate what's going to be the better option for you on any given year. Because some years it might be better to do a traditional, other years might be better to do a Roth. There's also a third option called a non-deductible IRA. So it still uses the traditional IRA structure. It's not a Roth, but the money that goes in, you don't get the deduction for, still grows tax deferred. But when it comes time to take the money out, the amount you put in isn't taxed, but the growth is. Typically, if you're thinking about doing a non-deductible IRA, you're going to be better off doing a Roth. But much like the deduction limit for traditional IRAs, there's an income limit for Roth contributions. If you earn over a certain amount, and it changes each year, you're not allowed to contribute to the Roth. So your only option might be to do a non-deductible IRA. And again, like everything else when it comes to retirement planning, there's pros and cons and trade-offs for using each option or combinations thereof. You're not limited to using just one or the other. You can switch back and forth or even split between them any given year. It can be flexible. Your options are flexible, and that's, at least when I'm talking with clients, that's something I try to stress a lot, is the flexibility of and knowing what your options are to take advantage of the situation at the time. And you need to stay on top of the different laws because they're always changing. They're getting tweaked, sometimes for the better, sometimes for the worse, but there are rule changes. So you do need to be aware of those. Just because you've watched one video or read an article doesn't mean the information given then is still applicable to when you decide to use it. So I definitely want to issue that warning out there. I hope this was a good introduction to what IRAs are. Hope you find it useful. If you have questions, please comment below. You explore our YouTube site more for other videos. Some introductory topics like this, some get a little bit more in depth. So please, subscribe, like us. Check out our website, afmgplanning.com. If you have any questions, please comment below or send us an email and we will respond. Hopefully be able to give you some advice, like general advice. And, if it needs to be more specific, we can talk about that as well. So enjoy the day and thank you for listening. Bye.